And have a listen to this. Have a listen to this.
Interest rates are higher, and people don't like that, but you should be welcoming a stronger economy.
And maybe a deal has a point about the machinery of capitalism being oiled with the blood of the workers.
The United States is a country that has always paid all of its bills.
Lannister always pays his debts.
Don't let the bastards get you.
Hello and welcome to Comedian versus Economist. We demystify the world of money and help you get a handle on the bigger picture. My name's Adam and we're joined as always by my little older brother and real-life economist, Thomas. Hi, Thomas.
Yeah, g'day, Adam. How you going?
Doing well, thank you. I've got a torn hamstring because I thought I could play outdoor soccer in the over 35 Sunday League.
Oh.
Turns out I can't. Turns out even that needs some modicum of conditioning and fitness, which I don't possess. So
wow. I don't even think I could take on the under 8s these days.
Well, to put a financial spin on it, I bought new boots, which kind of feels like a waste of money now. Anyway, massive show coming up as always. And sometimes you have to find the nuance and listen closely to the language coming out of the big banks. Westpac and ANZ have updated their house price forecast, changing their language ever so slightly from yeah, you probably can't afford one to no chance, sorry. We'll take a look at that. Billionaire investor Ray Dalio has 5 mega trends for us. Big news or just more water under the bridge? And what can instant noodles tell us about the state of the economy? But first... It's the inflation that stops the nation. Thomas, what's going on with inflation in Australia at the moment?
Oh dear, that's quality. Though. Can we just flag that nom nommy for the highlight reel? Anyway. We don't pay you enough.
No, I know. That's literally where my preparation for this show ends. We're pretty much winging it from here on out.
Yeah, but no, that's right. Inflation data last week. This is still, the big news in town because the RBA is looking at this closely, wondering whether they're going to keep hiking or not. Softened as expected, 1.4% in the March quarter, which is the softest quarterly read in a year. So definitely does seem like things have peaked. The headline numbers down from 7.8% to 7%. The trim mean, which is, close to our RBA's concept of core inflation, that's down from 6.9 to 6.6. So headline inflation definitely heading in the right direction, definitely slowing down. I mean, the big thing is the goods story. So you think about goods and services. Goods prices seem to be on the way down. Big discounting in clothing, footwear and furniture that we're seeing. Appliances as well. So good time to go out and buy some stuff. Construction costs are falling. Actually, I mean, construction inflation is kind of interesting. Like it was running at 21% inflation over the year.
So what was running at 21%?
Construction costs.
Oh, construction costs, right.
Yeah, the cost of building a new dwelling. So the CPI has a basket of goods that it looks at. All the different things, adds them together. Each good has a weight. Construction costs has the biggest single weight of all.
It's because of all the metal and concrete, probably.
That's right.
Weighs a lot more than bread.
Yeah.
I can't believe we need to pay economists to work this out.
Someone's got to build a mass-weighted CPI index. So, but construction costs were running at 21%, which is why all the builders are going bust. That's easing, still at 13%, so still pretty, that's chuffing along at a pretty fast clip, but you're heading in the right direction, so that's good. Right. The other part of the story is Goldman Sachs started publishing a supply chain congestion index. And through COVID, once all the supply chain started bottling up, I don't really know what's in this index, but you could research it. I didn't. But that index is now at 1, which is on a scale of 1 to 10, where one is fully open and one is fully bottlenecked. So they're saying it's all the supply chain bottlenecks we had through COVID, they've now completely digested, worked through the system. Supply chains are fully open, back to being fully open is what they reckon,
Right.
which is why we're starting to see the goods prices soften.
Right. Because I heard something on the news this morning about construction was constrained, like services construction's constrained in the US because the goods bottleneck had eased up. So like you can finally, like the cost of the materials now had come down enough that the demand for construction was now huge. So because everyone kind of went, we're just going to stop building because this plank of wood's costing us $1,000.
Yeah.
So everyone kind of paused things. But now that the cost of goods has come down, they're like, all right, let's like tools up. I think we already established that tools up was the alternative to tools down in an earlier episode. Tools up was the call, and back on the job site. So, but now you can't get builders because everyone wants them because now the wood's finally
right.
appropriate. There you go. Little fun fact I heard.
Fun fact.
While I was eating my wheat picks.
But I mean, that's we're also seeing that. Like, so the big question has for the past year has been: is goods inflation going to translate or move into services inflation? And on the services side, things aren't looking so great. Service inflation's up 1.3% in the March, which is almost double the long run average. And we normally don't get a lot of inflation out of the services sector. So that's as a quarterly number is double its long run average, 6.1% over the year. Concerningly, that's still on the way up. So whereas goods inflation has clearly peaked, where headline inflation has clearly peaked, services inflation is still on the way up. So
is there any other kind of inflation that's going to pop up? Like, is it just goods and services, or is there a third? I don't know. Is there another one?
No. I mean, that goods versus services, that's just a sort of a taxonomy that we just we lump everything, we just divide things in the basket into goods and services.
Right. Okay.
Yeah.
All right. Because I read something else. I've been quite well researched this week, Thomas. That inflation's now become sticky. So we heard it was going to be transitory at the start, and that hasn't sort of petered out. That petered out, and now they're talking about sticky inflation. So is that kind of the services story then? Like goods inflation's cooled off, but we've got services. Is that what makes it sticky?
Yeah, that is exactly that is the issue, and it is starting to look a little sticky, which is concerning. Like you look at the big drivers of services inflation, it's rent, education, and electricity. Education's, I don't know why that's spiked. Yeah, don't know what's driving that. But when you look at rents, that's not easing anytime soon. Rents are still on a tear away and not looking to ease anytime soon. So, bad news for renters. And then electricity prices, Australia is still being gouged by their, world-beating gas cartel and still paying, extra, we're looking at, the default contract's going to jump 20 to 30% with the new financial year. So that's going to stay high. So that's concerning. So the big drivers of services inflation, they're not looking to turn. I don't know about education, but rents and electricity, they're not going to turn anytime soon. So that potentially does give us some sticky inflation, which means that the RBA is we got to crunch goods inflation enough to bring down the headline.
Oh, really? They can't do anything about services?
No,
it's just gone. That's see you later.
Well,
not our domain.
But no, you look at what's like rents and electricity, like. It's not really a demand story, like crunching domestic, cash flows for households isn't going to shift, definitely not going to shift electricity story, like that's being set by the gas cartel. And then rents, it does have some degree, but but rents is sort of locked in. We talked about this a bit before, that rents in the CPI is the total stock of rents. But we know the new stock of rent, the new flow of rent contracts are coming in really hot, growing at 10%. So that 4.9% in rents is probably going to push towards eventually 8-9% because it's working to a lag. So rents and electricity are both locked in. So that's concerning.
I think even more concerning is that bad news often comes in threes and ominous predictions come in threes. And Phil Lowe did say no interest rate rises till 2024. Inflation would be transitory. And so we just need to just let this play out and see what the third doomsday prophecy is.
Yeah. Soft landing is cancelled.
That could be it. Yeah. That could be it. We are in for a hard landing.
Yeah.
The big question, will we get a rate rise this week?
Yeah. Well, the inflation data was soft enough for markets to effectively rule out a rate hike this week. Which will be yesterday by the time this comes out. So markets don't think we've got one this week, but it is possible that we'll get another one. So the general view in the markets from the economists is that either we're done and there's no more rate hikes, or there will be one more rate hike, but it won't be this month.
Thank you, economists. Again, so the prediction is either rate hikes or no rate hikes. All right, Thomas, the banks are rubbing their crystal balls like, I don't know. I was going to try and come up with something, but I couldn't find anything that didn't make crystal balls sound rude, which of course it isn't. So they're they're forecasting. They're looking into the future. What do they think is in store for house prices now?
We're on the way up. We're off to the races, really. Yeah. So I mean,
bottomed out.
Bottomed out, yeah.
Right.
It's turned. I mean, the interesting thing, so Westpac's updated their forecasts. ANZ followed up a couple of days later, updating theirs. I think, Westpac was, for this year, for calendar 2023, we're predicting a fall of 7%.
Right.
I think ANZ were predicting a fall of 11%. They've now changed that around, and Westpac's predicting flat growth, so no growth in 2023. And Westpac, ANZ's about the same. So no more falls this year. We're done. Is
that a pretty big miss? Like, I don't want to keep hammering on like economists and forecasters and all this because I get like it's hard, right? But is that a pretty big miss if you were saying like we think it's going to fall 7%, or in the case of who was it, ANZ that said 11%, we think it's going to drop 11%, for it to then go, actually, it turns out probably we're looking more like zero.
Yeah. It is reasonably, and I think that points to the fact that everyone's surprised by this. So ANZ and Westpac weren't alone with this. Like they weren't the rogue forecasters in the negatives.
Of course,
I mean, everyone in the market was kind of around that measure. Nobody was saying zero. Nobody in the market was saying zero. So the housing market has been surprisingly strong. It really it has taken people by surprise that we have had such an aggressive rate hiking cycle, strong inflation as well, eating into household incomes, and yet house prices have turned. We got house prices are up in March. It's now, like looking at the daily and weekly data, April's now looking like a gain as well. So 2 months of gains, that's sort of locking in the bottom. It's kind of hard to see prices falling from here. The big thing with that is that like supply is still really limited. So new listings, the amount of new stock coming onto the market, that's 20% below the 5-year average. Right. So that's not much stock coming onto the market. And you think about, I don't know, have we talked about supply and demand?
Don't ask me what we've talked about.
Yeah, but like everything with prices are always set by supply and demand. That's sort of like that's economics 101. And in the context of housing, we're looking at the total stock on the market. That's the supply. Like it's not just how many new houses we're creating. It's like what's in the market right now. And so the new flow of stock coming into the market, that's 20% below average. The total listings, that's at their lowest level since 2010.
Right.
So we're really looking at a supply-constrained market.
And were there more listings available? Like, that's come down in recent times? Because for a while their house prices were all dropping, which does that imply that supply was higher, like just recently? So is this a recent fall-off?
No, that was probably more on the demand side. So as rates rose, people could spend less, demand fell. So that's what sort of drove the modest and really modest falls in historical context. That was all on the demand side, and supply remained quite constrained. And there was sort of the expectation that as prices started to fall, as rate hikes started to bite, sellers would go like, okay, particularly investors would just go, okay, we've hit the top of the market. There's not much more capital gains to get out of this cycle. I'm going to sell. But we just haven't seen that. It just hasn't happened. Supply remains constrained. And then on the demand side, we have had the rate hikes, but rental prices are growing at such a ridiculous clip that the ANZ particularly singled this out and saying like there's a push from renters into the housing market because being a renter just sucks hard right now.
Does it also mean too that investors are more inclined to, even with higher interest rates, to go, well, an investment property is still a good idea because the rental market's so strong? Like, that makes a lot of sense.
I think it's definitely easing the pain of rate hikes. I mean, CoreLogic did some interesting analysis on this and looked at it dollar for dollar. And on the median house with the median mortgage and the median rents have gone up $200, but mortgage repayments have gone up about $800 or $900. So investors are still out of pocket this cycle, even with because mortgage expenses. You know, every investor has a different story, but on average, investors are paying more for their mortgages than they're getting from rental gains.
Right.
But that still hasn't translated into much selling activity, which is sort of interesting. And now everyone's sort of like, well, you know, if it hasn't fallen now, it's probably not going to. And auction clearance rates are, auctions are selling well. But real estate agents are saying there's a lot of demand in the market. Yeah, we're away. And you look at Westpac's forecast so that we talked about 2023 being flat. For 2024, they're looking at 5-6% in Melbourne, Sydney, and Brisbane, and then Perth growing at 8%.
What's up with Perth? Anytime a list like this comes out, Perth's like either at the top or the bottom. Like, is that the mining thing happening over there? Is that
big influence on it? Yeah. It's an independent market.
Right.
Whereas I think people move more fluidly between Sydney, Brisbane, and Melbourne, Perth sits a bit, bit different. So it does march to its own beat a bit.
How's Adelaide going?
They didn't say. They didn't bother.
Can't believe it. We got shit going on here, man. We had Gather Round, we got Live Golf Tournament. If you want to get on it and watch sport, then Adelaide's the place to be. That's all I'm saying. Surely it's in the list.
Yeah, Westpac didn't touch it. ANZ is saying Adelaide's expected to fall by 1% in 2024.
What?
Yeah, but they're much more. They're not as bullish as ANZ as Westpac overall though. So, and Adelaide's been on a tear away. So and Adelaide hasn't really had a contraction yet, a correction yet. So right. I think they're expecting that just to happen in 23, 24.
And I think by now we all know what to make of forecasts. So I'm not too worried.
Yeah.
But I guess the big question, is it now a good time to buy a house then? If you can, obviously.
If you can.
Seems like it. Everything's going to go gangbusters.
Not financial advice, obviously, but
sure.
if the only thing driving your decision to buy was the cycle and you're hoping to buy at a cheaper price, you probably want to buy now, I think, just because nobody's expecting prices to fall any further.
Right.
So, yeah.
But again, we're worth checking in on previous forecasts.
Yeah.
To see how they played out.
True, yeah.
There's room here for a contrarian view of because there's always uniformity and consensus around these forecasts seemingly. So I think just a small blog somewhere where you just look at the forecast of, minus 11% on average, and you go, actually, I reckon it's going to be zero. Just baseless, baseless zero. You could say I've got a model, things like that. That's you can say I've got a statistical AI model.
Oh, AI. Yeah, now I like it. That's tweaked my interest.
I've got an AI. It's crypto-backed AI, and I reckon zero. The model is telling me zero. It's thousands of computations have arrived at that number. And if you're right, sometimes, ad space, baby, on the blog.
Yeah. Did ChatGPT come up with this business model?
All right, let's take a break here. Grab a quick word from this week's sponsor. After the break, we're going to be back with our old mate Ray Dalio and his 5 mega trends, plus what can cinemas and ramen noodles tell us about a recession. All that and more on Comedian versus Economist right after this. Welcome back here on Comedian versus Economist. You can, of course, send us an email if you like, cve@equitymates.com or via the website equitymates.com/CVE. You can also find us on Facebook and Instagram at CVE Podcast. But Thomas, our old mate Ray Dalio, billionaire investor, he's got some mega trends for us. What are we looking at here?
Yeah, so Ray Dalio, he's a hedge fund manager, legendary hedge fund manager at Bridgewater Associates. Yeah, he's taken his hand to history in recent years. Decided he's become a student of history and particularly like transition points in society. And he reckons we're at one of these inflection points. Yeah, he reckons that the world is on the brink of a period of great disorder, and this will disrupt domestic and world orders in ways that we have never seen in our lifetimes, but have happened many times before in history. What he's saying. So, yeah, he reckons there's 5 mega trends that are crunching into the current moment. The first is the big debt cycle, saying we've created enormous amounts of debt.
Oh, I thought you said the big bet cycle. I thought he was going long on a same game multi. My ears pricked up. I was interested. I was quite interested for a second. I'm like, oh, billionaire has tips for the NBA playoffs.
Yeah, doesn't end well when governments go in on a same game multi. So particularly with money printing, massive debt financing, and that's coming to a head because we've got high interest rates. Yeah, and he said these high interest rates mean these debt burdens are becoming unbearably high, and which that in turn means the system is close to the point where big restructurings will be needed. But these things never come easy because there's big political costs when you've got to cut spending and move into that sort of thing. It also potentially means higher inflation for longer. Like Nouriel Roubini, Dr. Doom, we've talked about before, he's also saying that he reckons that central banks will wimp out before they kill inflation because it's just the governments won't be able to handle their debt burdens. And they'll sort of push back on the central banks and go like, oh, can you just back off on the interest rates for a bit?
Is Dalio a bear as well? Is he like a bit bearish like, what's his name, Dr. Doom, Roubini?
Dr. Doom. Yeah, I think
I mean, he can't be too bad. He's a billionaire investor.
You
can't always be like, well, this is going nowhere.
Yeah. I mean, can be a bit bearish.
Right.
I mean, certainly I'd say he's bearish now. And he did. I think he early in his career he predicted the pop of the Japanese bubble back in the 80s.
Oh yeah.
And that's sort of where he made his name and made a bit of money.
Right.
So bearish, definitely on the bearish end of the spectrum.
Right. And he's not necessarily saying like global collapse or global financial market collapse or anything like that. He's just kind of saying this is a time of like upheaval and disruption. And
but also that's not going to be good for markets. That's what he's saying. Yeah.
Just trying to find a silver lining. Right. Okay.
Yeah.
Okay. So we've got debts. What else
so the second one is conflicts within countries. He's saying that we're at like these turning points in history are always preceded by big upheavals within countries, and we're seeing that now. This particularly the polarization in America gives a really stark example. Yeah, and saying that the 2024 US election is going to be hotly contested, and there's little sort of middle way left. There's no middle ground left anymore. People have polarized, and that's creating problems. And particularly talking about the US debt ceiling. So that story's come around again. The US is going to have to lift their debt ceiling. And Dalio saying that's not going to go as smoothly as people expect, and will become a big election issue that will split the country.
So it's back to debt again, though, isn't it? Like he's split out his first point and just cashed it in for 2 points. Back to his same game multi. I like it.
So the third mega trend is conflicts between countries. So it's conflict within countries, there's conflict between countries, largely over debt. Yeah.
Right.
No, he's saying like, we're at a bit like, and this is definitely true. Like the geopolitical landscape has shifted pretty quickly in recent years. Yeah, China, like particularly the US relationship with China. That's seen a big shift. It's interesting. Last week, US Treasury Secretary Janet Yellen, who you'll remember from our intro, we're still doing that. Yeah, Treasury Secretary, but she came out and said the US is not going to compromise on national security concerns. Quote, even when they force trade-offs with our economic interests.
Oh,
yeah. So
we'll go broke fighting a war. Damn it. If we have to.
Yeah, I mean that's effective. I mean, it's also like it's kind of an obvious statement that, you know, we're not going to sacrifice security and safety for money. Yeah. But the fact, you know, it's kind of interesting that where the world's at, that people go, ooh, that's interesting that someone would say that in government. Yeah. But yeah, so the interesting, but US has been like the political leaders and economic leaders have been sort of stealing their language around this and saying like, yeah, we know that there's going to be costs involved in decoupling with China, but we're willing to face those costs. Number 4 is natural disasters, saying that they're often a catalyst for ending these what he calls long-term cycles. And he's saying that climate change is a classic one because that's going to just create chaos everywhere, in ways that are impossible to predict, and also speed up inflation, particularly with and the energy transition story. That's going to be inflationary because that's going to cost more money to do that. So you've got that's in play as well. That's number 4. And then number 5 is technology. Technology is often at the end of a long-term cycle, big technological shift like an industrial revolution. He talks about AI and saying like could be positive, but it's very early days in AI and we don't really know how that's going to play out. So it's in play, it's in the field. It could not quite clear where it's going. Yeah, so but that only leaves that last one, that technology, as one that has some uncertainty. And he's saying at least 4 of the 5 megatrends are in play that you normally see at these turning points. So 4 of the 5 are there. You know, if in 1,000 years we look back and, you know, it's going to look pretty obvious, like a turning point was totally due where they were at.
It's interesting that he calls out technology and in particular AI because after reading the article that you shared with me about this, I just went to ChatGPT and I said, tell me 5 megatrends that will end the big cycle, as he called it. And do you know what ChatGPT came back with?
What?
Came back with, here's the 5, where it says, the big cycle refers to the long-term economic cycle that has been observed throughout history, characterised by periods of growth and decline. Here are 5 megatrends that could potentially disrupt or end the current big cycle. And ChatGPT went with artificial intelligence, obviously, pretty, self-important.
Talking up its own book again.
Climate change and sustainability, demographic shift. So that's something Ray Dalio didn't call out, was the population is aging. Digitalisation, the increasing prevalence of digital technologies such as Internet of Things, blockchain and 5G, which Dalio, I guess, also called out, but he just he roped it in with AI. And then geopolitical instability. So political instability. So very similar listing to what Dalio came out with if we just asked ChatGPT.
Do you reckon Dalio's a bot?
I think he could be. Yeah, that's my conclusion. Or he's started outsourcing his paid public speaking work. All right, Thomas, finally on the show, big news in the world of instant noodles. Ramen sales through the roof. What's going on?
Yeah, the whole instant noodle community has been talking about this one. No, we got results from Nissan, the Japanese company, not to be confused with Nissan.
Ah, right.
Nissin. They make cup noodles. Yeah, and their sales are booming, actually. So they saw ramen and cup noodles saw a huge surge through COVID as people stocked up their pantries and panic bought shelf-stable foods. But it's continued. They've been pumping along, and they reported a 41% increase in global sales in the fourth quarter of 2022.
Wow, 41%.
Yeah.
It's huge.
Massive. Yeah, huge.
Did people just not know about them beforehand? Could that be possible that people were like, wow, this is delicious and cheap? Share houses across the world are just like, did you know about ramen? Because I must admit, we stocked up on Wheat Bix. That was our go-to. I was like, if this is end of days, I'm surrounding myself with Wheat Bix. I didn't think about ramen.
Right.
But it would have been smarter because you just need to heat water, whereas you really need milk for Wheat Bix.
Yeah, I don't know. I mean, I would have thought everyone knew about 2-minute noodles, but there definitely seems to be a shift. I mean, I think some of that growth isn't just in consumers are actually expanding their market. So they're very happy with their attempts to enter the US market.
Right.
32% year-on-year growth in US sales. Yeah, and they've expanded their capacity for distribution by 15% in the US.
Traditionally a very Pop-Tart dominated market too, the US. So interesting to see that transition play out towards a more noodle-based snack.
Yeah, they're trying to break through that legendary wall of baked goods that protects the US market.
Right.
Yeah. Apparently the Americans like hot and spicy.
Right, that's their go-to.
Yeah, and chili tomato. That's what they're saying.
I've been a long believer that you can make any food slightly more interesting by the addition of chili. I think for any, like if you take a fairly bland, flavourless food, you just make it a bit hot. Yeah, Wheat Bix. I put a bit of sriracha on my Wheat Bix. No, like a bit of heat. It makes anything a bit more interesting. So I always go, if there's an option for a spicy instant noodle, that's me every day of the week.
Yeah. Well, I mean, it's interesting. It's interesting because US retail sales are falling down 0.1% in the month of March. So it seems to be, we talked about this trading down when we looked at Woolworths results a little while ago. I think this is a bit of this going on, that people are like, oh, I need a budget option. Going to get some 2-minute noodles. Yeah, which then ties in with theatre sales, which is US box office sales.
People are buying movie theatres too?
Yeah. No, box office sales in the US now back, have completely erased their COVID losses. They're back to 2019 levels.
So they're back to the same level. That's no surprise then. People didn't, it's hardly news that people didn't go to the movies during COVID.
No. But it's a strong bounce back. But theatres, box office sales are a recessionary indicator, oddly enough. So every time the US economy shrinks, US box office sales go up.
Right.
So it's pretty consistent sales.
I thought you were just talking about more people going to the movies, which I guess it is, but I thought that might happen during a recession because of how ridiculously easy it is to just go into a movie for free these days. Like, have you been to the movies lately? It's all run by like computers and QR codes. And it's literally never been easier to just sneak into a movie. You just get your phone, go online just before the movie starts. You can see literally what seats are still available. You just wander in and sit in one.
Right.
Get out your flask and start mixing up your mega jumbo instant ramen that you brought with you. Not financial advice, obviously, and I don't condone sneaking in and not paying for the movie theatre, but I'm just saying, like, even as a legitimate ticket holder taking the kids to the movies over the school holidays, it was like painfully obvious at how easy you could just wander into the cinema and take a seat and watch a film. Like, but I guess if you're saying box office sales, that implies people are buying tickets.
Yeah. Well, I mean, sales of really long trench coats you can fit 2 people in are down. So maybe that thesis plays out.
And I wonder too whether there's like just groups of children going to the movies, because that's another I'm giving away all my secrets, but that's another tactic that friends of mine use, is to just buy a kid's ticket to like the footy or whatever, because you just need a valid barcode to scan in for the seat. The seat doesn't check who's sitting in it, whether it's an adult or a child.
Gotcha. Right. Yes. So follow CVE for more money-saving tips.
As we did navigate these inflationary seas, stick with CVE. No, sorry, don't break the law or do anything like that. But I'm just saying, some people out there, some unscrupulous people, are trying to rort the system. So be on the lookout. And if you see any of them, report them to CVE, including their tactics and strategies that they're implementing, and we'll pass those on to the relevant authorities. All right, let's leave it there. Thank you so much for tuning in once again. We love that you're listening. We love it also if you would go and leave us a review and a rating wherever you get this podcast. It does help us enormously. But for us this week, it is bye for now.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.